Most people will hear the latest headlines about the Iraqi dinar and walk away more confused than informed. Some will see words like exchange rate, budget, 2026, and assume it means either an instant windfall or an imminent collapse. Both reactions miss the point, because what was actually said, quietly in technical language, wasn't a prediction, it was a warning. Not about tomorrow, not about next week, but about the structural decisions being made right now that will determine whether the Iraqi dinar remains stable or comes under pressure again. This isn't about rumors, it's not about secret revaluations, and it's definitely not about overnight miracles. It's about how Iraq manages its money, its spending, and its dependence on oil, and how those choices ripple directly into the value of the dinar. If you're holding dinars, if you're tracking Iraq's economic reforms, or if you want to understand what actually moves currencies in the real world, then you need to understand what this statement really means. Because beneath the technical language is a roadmap, and ignoring it is far more dangerous than any headline. The statement didn't come from a politician making promises. It didn't come from social media speculation, and it didn't come from anonymous sources close to the government. It came from a senior financial advisor inside Iraq's monetary system, someone whose role isn't to excite markets, but to explain how the system actually functions. When people in this position speak publicly, they don't talk about outcomes, they talk about conditions. They don't announce currency moves, they outline constraints, responsibilities, and risks. That distinction matters because policy advisors aren't trying to tell you what will happen, they're telling you what must happen for stability to exist at all. And when a figure like this emphasizes coordination between fiscal policy and monetary policy, it's not academic language. It's a signal that the system is under stress and that future stability depends on decisions that haven't been made yet. This isn't hype, it's institutional signaling. And understanding the difference is what separates speculation from real analysis. To understand why this statement matters, you first have to understand how the Iraqi dinar actually works, because it does not behave like most major world currencies. The dinar does not float freely. Its value isn't decided every second by global traders like the euro, the pound, or the yen. Instead, Iraq operates under a managed exchange rate system. That means the central bank actively defends a specific price for the dinar against the US dollar. Right now, that price sits in a narrow range, and keeping it there requires constant intervention. Here's how that intervention works. Every day, Iraqi banks and exchange companies need US dollars to pay for imports, international contracts, and cross-border transactions. To meet that demand, the central bank supplies dollars from its reserves. Those reserves come almost entirely from one source: oil exports. Iraq sells oil internationally, gets paid in dollars, and those dollars flow into the central bank. The bank then releases those dollars into the domestic system to maintain currency stability. As long as dollar inflows are strong and well managed, the exchange rate holds. But this is where most people misunderstand the risk. Currency stability isn't just about how many dollars the central bank has. It's also about how many dinars are being created and spent inside the economy. And that's where the Ministry of Finance enters the picture. If spending runs ahead of revenue, if deficits grow, or if inflation accelerates, pressure builds, not quietly, but mechanically. More dinars chasing the same goods means higher prices. Higher prices mean weaker confidence. Weaker confidence means more demand for dollars. And when that demand spikes, even strong reserves can be drained faster than expected. This is why exchange rates are never just a central bank issue. They are the product of two institutions working together or failing to. And that brings us to the real warning embedded in this statement. A currency doesn't collapse because of one bad decision. It collapses when institutions pull in opposite directions. This is where coordination becomes everything. The central bank's job is to control inflation, manage reserves, and protect the exchange rate. The Ministry of Finance's job is to spend, collect revenue, and run the state. When these two institutions are aligned, stability is possible. When they aren't, pressure builds silently until it breaks. Here's what misalignment looks like. The central bank can try to hold the exchange rate steady, but if the Ministry of Finance is running large deficits, the system starts leaking. Government spending injects more dinars into the economy. Those dinars compete for the same limited supply of goods and services, pushing prices higher. As inflation rises, confidence falls. People don't wait for official announcements. They protect themselves. They convert dinars into dollars. They move savings out of local currency. They increase demand at the currency window. That demand doesn't show up as panic. It shows up as volume, and volume drains reserves. This is exactly how pressure builds beneath the surface. Not overnight, not because of rumors, but because fiscal behavior undermines monetary control. Iraq has lived this cycle before. When oil revenues fall and spending remains high, the gap has to be filled somehow: borrowing, monetary expansion, or currency adjustment. None of those options are painless. This is why the emphasis on coordination is not a theoretical discussion. It's an acknowledgement that past instability wasn't accidental, and it's a signal that avoiding another episode requires discipline, not slogans. Which leads us to the timing of this message and why the year ahead matters more than most people realize. When policymakers reference a future budget, they're not talking about paperwork. They're talking about commitments. Budgets lock in assumptions, and assumptions shape outcomes. By pointing directly to the 2026 budget, this statement is signaling that decisions being made now will echo through the exchange rate over the next several years. Iraq's budgets are built on forecasts: oil prices, export volumes, spending levels, public sector wages, subsidies, and debt obligations. If those assumptions are realistic, the system holds. If they aren't, pressure becomes inevitable. This matters because Iraq has a long history of optimistic budgeting, expecting oil prices to stay high, revenues to flow smoothly, and spending promises to remain affordable. When reality doesn't cooperate, deficits appear, and deficits don't stay confined to balance sheets, they move into the currency market. A budget that expands spending without securing sustainable revenue doesn't just strain public finances, it increases demand for dollars and weakens the central bank's ability to defend the exchange rate. That's why the mention of 2026 is deliberate. It's a window of opportunity, a chance to correct structural imbalances before they become currency pressure, or a chance to repeat the same cycle under different headlines. The exchange rate won't react to speeches. It will react to what's written into law. And that brings us to the specific conditions being outlined, not as suggestions, but as requirements. When officials talk about stability, they rarely list requirements publicly. This time, they did. And those requirements aren't abstract ideas. They're measurable conditions. First, expanding non-oil revenue. Iraq's greatest vulnerability is not the dinar, it's dependence. The government still relies overwhelmingly on oil to fund the state. When prices are high, the system looks stable. When prices fall, everything tightens at once. True stability means the government can function even when oil markets don't cooperate. That requires effective taxation, stronger customs enforcement, and revenue from sectors that already exist but remain underdeveloped: trade, telecommunications, agriculture, transportation, and services. These aren't future industries, they're present industries that haven't been integrated into the fiscal system. Until non-oil revenue becomes meaningful, every oil price swing translates directly into currency pressure. Controlling public spending. Iraq's public sector payroll is massive. Salaries, pensions, and benefits absorb a huge share of the national budget, leaving little room for investment in infrastructure, education, or productive growth. This isn't just an accounting problem, it's a structural one. When spending grows faster than revenue, deficits widen. When deficits widen, inflation pressure increases. And when inflation rises, demand for dollars follows. Spending discipline doesn't mean cutting support overnight. It means slowing unsustainable growth and prioritizing productivity over politics. Without that shift, monetary policy is forced to carry a burden it can't sustain alone. Third, reviewing embedded financial costs. Budgets don't just include salaries and projects, they include obligations, subsidies, debt servicing, guarantees, and off-balance sheet costs. These commitments often expand quietly, but their impact is very real. If future budgets absorb new costs without reforming old ones, pressure accumulates beneath the surface. This is why reviewing financial obligations isn't technical housekeeping, it's currency defense. Each unresolved cost narrows the margin of stability. Together, these three conditions form a framework, not for revaluation, but for survival, stability, and eventually credibility. And without credibility, no currency strengthens. While internal reforms are critical, Iraq's currency system doesn't operate in isolation. Over the past 2 years, external oversight has intensified, particularly around how dollars move through Iraq's banking system. Access to dollars is no longer automatic. Banks must now document transactions more thoroughly, prove legitimate trade activity, and comply with international financial standards. These controls were designed to reduce illicit flows, curb smuggling, and protect Iraq's access to global financial channels. From a stability perspective, this is a necessary step. A currency can't remain credible if large volumes of dollars leave the system through informal or unverified channels. But these reforms come with short-term consequences. Businesses that once relied on fast, informal dollar access now face delays and restrictions. Some trade activity slows, liquidity tightens. This creates friction, not because reform is failing, but because the system is adjusting. At the same time, Iraq continues working to expand oil production capacity. More output means more dollar inflows, strengthening reserves and supporting the exchange rate. However, production alone isn't a shield. If global oil prices fall sharply, higher volumes won't fully compensate. Revenue risk remains. This is why fiscal discipline matters so much. External controls can stabilize the flow of dollars, but they can't fix internal imbalances. And that brings us to the question many people are actually asking, not about stability, but about revaluation. This is where expectations often drift away from economics. The idea of a sudden, dramatic revaluation is emotionally appealing, but currencies don't move that way in functioning systems. A currency strengthens when demand for it grows, not because of announcements, not because of rumors, but because people and institutions want to hold it. That demand comes from productivity, diversification, low inflation, reliable banking, and investor confidence. What's being described here is not a shortcut to appreciation, it's a framework for stability. Stability is not weakness. A stable currency preserves purchasing power, protects savings, and builds credibility over time. Without it, appreciation is impossible. If Iraq succeeds in restructuring spending, expanding non-oil revenue, and coordinating fiscal and monetary policy, the dinar can remain stable and, over time, gradually strengthen. But that process is measured in years, not moments. History is clear on this. Currencies that appreciate sustainably do so after reforms take hold, not while they're being debated. Understanding this difference protects investors from disappointment and from decisions driven by noise instead of fundamentals. Which leaves one final question. What should people actually watch going forward? First, watch the budget process. Pay attention to whether spending growth slows and whether revenue assumptions are realistic. Second, track non-oil revenue. Customs collections, tax receipts, and state enterprise income will show whether diversification is real or just rhetoric. Third, monitor inflation trends. Stable prices signal fiscal and monetary alignment. Rising prices signal pressure. Fourth, watch the central bank's reserve levels. Reserves are the backbone of exchange rate defense. Consistency matters more than peaks. And finally, watch oil, not just production, but prices. High output can't offset low prices forever. These indicators won't make headlines, but they will tell the real story. They show whether Iraq is building durability or merely buying time. The future of the Iraqi dinar won't be decided by rumors, predictions, or viral headlines. It will be decided by discipline in spending, in revenue, and in coordination between institutions that shape the economy. What we're seeing now isn't a promise of revaluation. It's a test of whether Iraq can sustain stability long enough to earn credibility. That process isn't dramatic, it's deliberate. And those who focus on fundamentals will always be ahead of those chasing noise. If you want clear, data-driven analysis of Iraq's economy and currency without hype or false promises, subscribe and stay informed. Because in markets like this, understanding matters more than timing.